The Nasdaq 100 is now down 13% from its record all-time high. The S&P 500 and the Aussie share market are both down 10.1% from their records that they just hit about 1 month ago. It's seriously time to start considering what would happen if markets fall another 10% from here. And what happens if you buy the dip? Welcome to The Daily. My name is Jessica Amir, a market strategist here with Mumu. You're tuned in this Friday, March the 14th. So perhaps we throw out the question that it should be time for you to reset your expectations on where markets could go from here, perhaps over the next couple of weeks or months. And that's because what we're seeing right now in markets is selling is fierce, pretty much like what we saw in 2018. Remembering in 2018, that's when Trump's first trade wars came into play, when he kicked off tariffs on steel, aluminium, and tariffs on China. And then markets fell about 20% from peak to trough. So if history repeats itself and the markets fall another 10% from here, that is now, I guess, a scenario that seems quite probable. But let's remember, the market is forward-looking. The market is ultimately a reflection of the health and the direction of the economy and how much it sees companies' earnings growing. But right now, why we're saying there's so much uncertainty in the air is because we're waiting for further changes and economic policy and additional tariffs to be brought in. When is that? Well, of course, remember the April 1 deadline that Trump and the US government have set. After that, that's when, ladies and gents, you might be expecting company earnings expectations to be materially shifted and ground down. But do consider what you should maybe expect from here. What I want you to also consider is that some investment banks have been pretty quiet of late. I haven't really seen many people talking about buying the dip, simply because the scenario is we don't know what's ahead. But what I can tell you is the market's level of fear, as tracked by the VIX, that's what we call it, it's a volatility index, that's fallen a little. It's actually fallen from its 7-month high, but I'm still seeing huge sell orders from institutions in NASDAQ 100 stocks, which is why we've got a chart for those who are tuned into the podcast. We're just showing a chart of all the key indices, the S&P 500, the NASDAQ 100, and the Aussie share market. They're down 10%, but we're seeing more selling in these key indices by institutions. In fact, institutions are heavily selling into NASDAQ 100 stocks such as Nvidia and Tesla. But the good news is I'm starting to see institutions such as BNP Paribas buy into names like Microsoft, scooping up 1.4 million of their shares overnight. Also seeing lots of Apple orders come through. BNP Paribas has bought 591,000 shares on Apple. On the other hand, we're also seeing some global banks start to tell their top private clients that they should be topping up defensive exposure, buying into bonds, precisely corporate bonds, because they are offering refuge in times of uncertainty. Another scenario is, what about if you consider buying into safe havens such as bonds or even ETFs such as gold? Or what about if you just stay the course? Remembering, as we've been saying for some time, that markets have always recovered from a bear market crash. And when I say markets, I mean the key major indices. Here's a chart of the S&P 500. For those that are tuning in on the podcast, we're basically illustrating the performance of the US market since 2018 up until last night. It basically illustrates that the market has always recovered from a market crash, including Trump's first trade war back in 2018. But what about if you bought into the dip halfway through that bear market? Remembering the market, as we said at the outset, the market fell 20% in the Trump trade war of 2018. What if you missed time buying the dip and you bought about 10% into the pullback? So you saw the market had fallen 10% and you bought in, and then the market continued to fall 10%. Well, if you held the ETF that tracks the S&P 500, if you held that for 5 years, you'd still be up 73%. So if you chucked in, say, $10,000, you'd now have $17,300. That basically shows you there is much to be said about taking a long-term view and remembering what we're saying, markets have always recovered from a bear market crash. What about the Aussie share market? Well, the Aussie share market, that's also recovered from a market crash as well. But today, the Aussie share market is expected to grind down ever so slightly. Risk-off tone, of course, in play. But commodities, they're expected to shoot the lights out, and they're offering plenty of bright sparks. Remembering that the Aussie share market is rich in commodities, and it's good news today for those who are holding gold stocks, because we've seen the gold price hit a brand new record all-time high of $3,000 for the first time in history. That's right, the gold price is now up 14% this year. Silver is following, it's up 17%. Copper's up in hot pursuit, up about 11%. So those who are in commodities such as these base metals are doing particularly well. Remembering the narrative for gold is particularly bullish, given what we said yesterday. The US government is continuing to see their debt levels explode. Global debt levels are also continuing, and that's exactly why central banks are increasing their buying of gold, because there's concern about credit issues. And again, remember, uncertainty is in the air until April 1. That's the deadline for all tariff policies to potentially be brought into play. So this is why you should be watching gold ETFs, gold stocks, and indeed the gold price. Here's an ETF that we are displaying on the screen. For those who are tuning in for our podcast, we're displaying the ETF BAR, that's the GraniteShares Gold Trust ETF. That basically mimics the price of gold. Indeed, that's why this ETF is up 14% this year. So I suspect some gold holders will be popping the champagne today, because it seems like gold is indeed the key winner of this trade war. For all ETFs and stocks we've mentioned today, please head over to Mumu's platform and you'll find a vast array of information and earnings estimates to sink your teeth into. Stay safe, happy trading. We'll see you for the weekly.